my name is Farhad Abasov. I'm the chairman of Millennial Potash. Millennial Potash has been developing its Banio potash project in Gabon for the last 18 months now. It is quite advanced at this point. We've drilled a couple of holes. We have made a resource estimate of about 1.7 billion tons of indicated and inferred resource. And we also finished a preliminary economic assessment earlier this year with very strong numbers. We're looking at after-tax NPV of about $1 billion and very strong IRR, one of the lowest cost structures in the industry as well.
Farhad, good to see you. Good to see you. And good to be talking about your new project. Congratulations.
Thanks,
we should probably start off for people who don't know you as well. Maybe start off with some of the background and maybe some of the team, because you kind of brought the band back together here a bit.
Yeah, no, thanks, Matt. Good to see you after a long pause. So look, I mean, you're right. I mean, I think last time we spoke, it was with another Millennial. It was Millennial Lithium. It was a lithium brine project in Argentina with the same team, basically. And we took that project from about $30 million market cap all the way to $490 million in 2022. And we got into a bidding war, whereas Ganfeng Lithium, CATL, the largest battery manufacturer out of China, and Lithium Americas were bidding for Millennial Lithium. So we ended up selling it to Lithium Americas. So it was a very good exit for all of us. And before that, of course, you remember we spoke about we had a couple of potash projects in the past. And again, we exited quite successfully. One was in Ethiopia called Alana Potash. The other one was in Saskatchewan called Potash 1. And this project was started relatively recently. It was March 2023 when we took it RTO in Canada. And since then, we've done quite a bit of work, as I mentioned briefly, but most importantly, we started drilling. We put out the PEA, and I'll tell you more details later on. But the team is the exact same team. I mean, that's one of the rarest things in this industry, Matt. We have been together as management team for almost 17 years. So we're really proud of it that, we're still together and we don't hate each other that much. So back to the new project now.
Fantastic. Well, look, again, it might be useful to just kind of help people understand what all the variables are. I'm going to start with potash. Let's kind of keep it simple, probably quite quick in terms of the market at the moment. Who are the big players in there, if you don't mind?
Yeah, sure. So look, man, usually we do quite a bit of supply-demand dynamic analysis before we get involved with any specific project. And of course, we look at jurisdiction. So we've done a couple of potash projects in the past. So we know potash quite well. The team is heavily potash-oriented as well. So frankly, the industry hasn't changed much in the last 10, 15 years. It's been dominated by three major countries. It's Canada, specifically the province of Saskatchewan, and then Russia and Belarus. So among those three countries, they basically provide almost 70% of potash supply globally. And then, a little bit of supply comes out of Germany, out of the Middle East, out of Western China, etc. But really, the mammoth players are those three that I mentioned. The rest of the world, obviously, buys, imports, and consumes potash. Now, the largest agricultural countries, such as the U.S., China, Brazil, India, they are the major importers. In the case of Brazil, it's the largest importer of potash. They import about 13 million tons of potash per year, followed by the US and China, about 10 million tons each, and then India, about 5 million tons. Now, potash, of course, is fertilizer. For those who are not familiar with what it is used for, of course, it's used for some other things as well, but probably 95% of potash goes into the soil as fertilizer. And it's trading between $300 and $400 per ton, depending on the market right now.
Right, and if you've done that supply and demand study, then what's the delta like at the moment? Is there room for you guys? Can you make money? Is it going to affect pricing in the market?
Yeah, so that's exactly what we looked at. Whether this project that we were looking at the time we're doing due diligence on can actually go all the way to production, and why. So there are a few factors that worked in our favor, and that's what we look at all the time. One is, of course, the project itself. It was previously explored. That was very important. So we knew that there was quite a bit of upside potential. I'll talk about it in more detail later on. The second thing was it is in Gabon. Gabon is one of the best jurisdictions in Africa. The country actually probably one of the wealthiest countries there on the GDP per capita basis, probably the wealthiest on the continent because of its oil revenues and smaller population. And it is in a very good location within Gabon as well. It's right on the coast. So our thinking was, look, if we can find a large resource with strong economics, then perhaps we can actually build this project as African potash project for African consumption, because Africa as a continent imports about 2 million tons a year. There's no domestic production, and we thought that this would make perfect sense, considering that obviously we're there. There's a growing demand for potash in Africa, but also it's not a very large market, meaning that we will not be competing head to head with Saskatchewan-based players or Russians or Belarusians for that.
Okay, there's so many questions. It's a fantastic. Okay,
Yeah.
Gabon, you mentioned. I've worked in Gabon with Ali Bongo.
So you're one of the few people who has been to Gabon. Yeah, okay.
Yeah. No, actually, I was introduced to him by Michael Jackson's brother, Jermaine Jackson.
Really?
As he
Okay.
played. Yeah, there's lots of stories. Bass guitarists everywhere.
Yeah.
Okay, so Gabon is obviously a small country, wealthy country, has lots of natural resource there. Doing business in country. Tell us a little bit about what that's like.
So, Matt, before we actually took this project on, we did quite a bit of due diligence. We had flown a number of teams there, both on the technical side, legal, and just operating team as well, just to understand what it's like to work in Gabon. So not only had we spoken to all the government officials, all the key people, so to speak, in the government, but we also actually went out and spoke to all the operators on the oil and gas, mining side, so just to see what happens actually on the ground. In other words, in terms of permitting, in terms of regular operations, even in terms of importing things through customs and so forth. And we really liked what we found out. And since we started working there, this was like starting in March of last year, we haven't seen any issues at all. So we've seen very strong support from the government. There was a change of government, by the way, in August last year. Since that, we've met with all the key people. I met with His Excellency the President as well, and he has visited the site too. So we see significant support, not only in terms of government support, in terms of permitting, et cetera, but also in terms of infrastructure buildup. And that's very important as well. Now, Gabon is obviously quite familiar with foreign direct investment because of oil and gas industry, quite well developed oil and gas industry, I should note. And a few years back, they decided to open up their mining sector to attract more direct investment into mining, diversify away a little bit from oil and gas. And they really overhauled their mining laws. So it seems to be quite, keen on actually attracting and retaining a lot of foreign direct investment. And one other thing about Gabon, Matt, is that they're what I call geopolitically neutral. So they get along with many different, I would say, parts of the world, including the West, the US, France, UK, etc. Of course, we're a Canadian company, so they welcomed us as well. And they have significant investments from the East as well, including China, India, and from Latin America. So that is important for us because obviously, although we're listed in Canada, we're a global company. We do have investments coming into the company from all over the world.
Right, and you'd be glad to hear there's lots of lithium there too.
Yeah.
When the time is right, and hardwood, would you believe?
Yes,
Good business.
yes, for sure.
Let's talk about the PEA, the study. Let's try and understand those economics. I want to kind of move to the kind of commercial and commercialization component here. So remind us of the PEA numbers.
Yeah, so Matt, before the PEA, we did a couple of drill holes. So basically, we took historical drill holes and extended them further, and almost all of that extension intersected potash. So that was very important for us. So that 1.7 billion tons of indicated and inferred comes actually from those two drill holes. Now, we think that upside potential is huge because those two drill holes cover only barely 2% of the entire property. And the property is over 1,200 square kilometers. So we think it's going to be a real world-class size. Now, on the PEA, we decided to focus on a solution mining approach and start with 800,000 ton a year operation. So this is not a very large scale, but at the same time, not too small. But it's perfect for the project of this size, but also for Africa. In other words, we think that we can relatively easily place almost all of that 800,000 tons in Africa proper. Now, the PEA numbers came out actually much better than what we had expected. On the OPEX side, we're looking at $61 per ton. Just to give you a comparison, Matt, it's like the lowest cost operators in the world are in Saskatchewan, again, Russia and Belarus. They also happen to be the largest producers of potash. and they're looking at $90 to $100 per ton. We're at $61 per ton, and even if we're off by 50%, we're still gonna be close to that. So that is the most important thing about this project, and that is possible because of very thick potash horizons. We're looking at almost 70-meter thickness in the northern part of where we drilled, and double that as we go to the south. And we're going to be using solution mining, as I mentioned.
Can we come back to the bit we've done 2 drill holes, and you've extrapolated out to? I mean, how does that work with potash?
With potash deposits, and this one is no different. They happen to be very uniform and continuous. So you don't need hundreds of drill holes like in the case of, let's say, precious metals or copper, etc., because pretty much it continues for kilometers. Now, the reason that we could do that here is that we had plenty of historical exploration data. So as I mentioned before, when we started drilling, we already had 2 clusters of drill holes, historical drill holes. The ones that we did this time were basically extension of the drill holes from the 2017-2018 program. But we also have drill holes dating back to the 1970s. On top of it, we have seismic data. So all of that actually gave us pretty good understanding of the geology here. But in terms of that particular resource, yes, it's literally based on just 2 drill holes. So that's why we think at the next stage, we can drill 2 more by stepping out from those and probably double that resource.
Right, okay.
It is so continuous that you can actually trace it back to 20 kilometers away from the current drill holes. Matt, so because we have historical data about 20 kilometers southeast from us.
Okay, so that's really, look, you're saying this from a position of knowledge. You've done this a couple of times for potash companies, right? So I'm asking because I don't understand it. I imagine a vast swathe of the audience won't understand that either. So I guess it's well, two holes don't cost very much. So that's good, but the assumptions are really, really important to understand. And how can we validate that if we wanted to go and sort of look at other projects or companies who've done the same thing?
So the same thing. So for example, in Saskatchewan, and with Potash One, we drilled only about 5-6 holes in total.
Okay.
And we had already billions of tons, and we ended up selling that one, as you remember, for $434 million. So it is quite similar. It really depends on potash deposit. Like again, in Saskatchewan and Russia. In here in West African deposit, that would be similar. It's pretty uniform and continuous to the point, man, where when we're drilling this hole, extending one of these holes, our German consultants who had worked in the Republic of Congo, because this deposit obviously extends into the Republic of Congo all the way down to Angola, and there are quite a few projects in Congo. They could tell us exactly at what depth we're gonna hit new potash cycle, which was shocking even to me because it was 150 or 160 kilometers away. And I was chuckling, and we did actually. Every time we'd go, they said, well, 545, I'm going to hit another one, 550, another one, and so forth. So that's how continuous it is. But again, no surprise as far as potash is concerned.
Right, and talk me through, like, I mean, your model is, well, actually, you explain your model in terms of how you monetize these things.
Matt, our model is pretty straightforward. So we develop these projects on what we call dual track basis. So one is to make sure that we can actually take it all the way to production. So as we go into the feasibility study, we start working on putting together financing for the construction. And on the second track, we basically want to make sure that we get potential interest from acquisitor. And then, of course, that we get good value, then we sell the project before we get to construction. Now, in the past, almost always we've sold before construction. Although with the uranium project that we had many years ago, we did build one of the projects in Texas and launched it. We still got acquired after that, but generally speaking, again, the plan is to take it to the point where make a decision after the feasibility: do we sell or do we actually pull the trigger on financing and start construction? So it all depends on what kind of value we'll get at the time.
Okay, and now we've interviewed a fair few potash companies on this show. Not necessarily with your heritage and experience, but they seem to fall over, right? And they seem to fall over for a number of reasons. So what's the secret? So what are the things that you like to see in place to ensure they don't fall over?
So Matt, there are a few things. First of all, the project itself. But again, you're absolutely right. There's some interesting potash projects worldwide. They still stumble. The second thing is the jurisdiction. you can have a very good project. And this is frankly, this applies to anything. It doesn't just apply to potash, to any other commodity. You may have a great project, a great, product, so to speak, in general, in terms of economics and so forth, but you may be in a wrong jurisdiction, meaning it will be very difficult to attract capital there, or, there's some sort of instability, be it economic or political and so forth. So that's another very important factor. The third one is actually having the right backers. I'm talking about, of course, financing, your financial backers. So what we do, and we are working on it, and I'll talk about it momentarily as well, is to get right partners, right financial partners early on, so that you can actually develop the project all the way to the point where you can make those important decisions. I mean, to give you an example of our other potash project, or even with lithium, frankly, we did the exact same thing. But with the potash project in Ethiopia, we brought in International Finance Corporation out of Washington, D.C. as our cornerstone investor first, and it de-risked the project a lot, that threw significant political support behind the project too. And after that, we brought in a large P fund from the U.S. as well. And then, of course, a strategic ICL out of Israel came in. I mean, they eventually bought us out, but they were in as a strategic first. So I think those are important elements that you have to have in place, in addition to the project's viability, so to speak. Because without those, it's very difficult. And of course, the project itself has to have solid legs, and you should be absolutely confident that it will hit production. Whether on your watch or not, that's a different matter, but that the project can actually get to production and be competitive.
Right, and I guess what we've seen elsewhere, jurisdictional risk is thrown into that mix as well. Okay, so right, you've got the team because you've done it before. You've got a formula. This isn't necessarily obviously going to be directly cookie cutter approach, but you feel that the potential issues have been are negligible or have been negated, and so now what do you have to do? What's left to do after the PEA?
So, but again, we have the same kind of a development plan applied to all these projects, be it lithium, potash, uranium, or whatever. So here, we're basically following the same program. Here, we finished the initial drilling, we got out PEA. The next step would be to expand this resource. That resource, we think, is going to be, probably 4 or 5 times bigger than what we found. But at this point, that's not what we're planning to do. What we want to do is really double the resource so that we can have enough measured and indicated to go into a bankable feasibility study. So the next step for us would be to drill 2 more holes. And we already have a capital for that. We just raised capital from our insiders. So that will give us enough funding to do that program. And then next year, we want to start a bankable feasibility study. And we will be launching environmental studies probably in the next few weeks as well. So those 2 programs, bankable fees and environmental studies, will be going on parallel tracks. And the plan is to complete them by the end of 2025.
Right, and at what point do you start talking to end buyers? You're talking about feeding into the African market. Have you started that process?
Yeah, man, we usually start with those things pretty early on. So we started actually this year. So we started talking to potential off-takers, both in Africa proper, in South America, and in Asia. We're also talking to some Western groups as well on both financing and, of course, off-take. And we've been talking to some large private equity funds too, who are quite interested in the project. Of course, they like Gabon, and some of them actually have invested with the management before, so they know what we can or cannot do with this project specifically. So the plan is basically, again, bring it to the point where, first of all, in the next few months, we'd like to get in as one of the large strategics. And by strategic, I mean it could be a P fund, it could be a development finance organization, meaning multilateral finance organization, and those are usually from the West, or potential off-taker. Now, with the off-takes, you remember, Matt, we had exact same approach with lithium. We don't really want an off-take without any kind of financing component or funding component to it. So I want to make sure that the potential off-taker can invest in the company or make prepayments and so forth. That will help us with our development programs. So that's why, off-take is not just an off-take. If we do an off-take, it will come with significant financial commitment on the part of the off-taker. In terms of the plan, in terms of the timelines, I should say, the idea is that for feasibility study, we'll need to raise more capital. I would like to raise it from a strategic versus raising it from the capital markets. Maybe part of it will be done in the open market, but usually, we'll bring in a cornerstone investor at that point.
Right. So okay, I understand how you want to structure it. So in terms of coming back to that demand side of things, you want to feed into Africa. Clearly, you don't want to. No one wants to ship this as further than they need to. So is there kind of an immediate requirement around you, or have you got actual names of conversations or countries of conversations that you're having?
Yeah, actually, we're talking directly to some of the users, but we're also talking to distributors of fertilizers. Not only potash, they distribute other fertilizers as well in Africa, and they're telling us probably half of our potential production, meaning 400,000 tons, could be placed in West Africa and South Africa alone. So this is a particular group that actually deals with it. So that is very encouraging, Matt, because we didn't realize that so much material actually was being consumed in our vicinity. So that is important. And of course, we can go outside of West Africa and South Africa. Morocco is a big user, Egypt and so forth. But at this point, we're looking in our region, so to speak.
Right, and obviously that's not your business. Your business model is to flip these things off, but have everything in place for someone to be able to walk in and acquire this. So, in terms of prospective acquirers, obviously it's a very small, vertical that you're operating in. Has the kind of global, like, I guess, bifurcation of political attitudes, we'll call it, where East versus West is going on at the moment. Does that affect the amount of potential acquisitors that you've got?
Well, that's a very important question, Matt, because we're attending one of the mining conference a couple of weeks ago, and I was in a panel discussing that, kind of the geopolitical tensions and the impact on African mining. So it is an important factor. Frankly, in our case, we'll look at it positively, meaning that, it is an opportunity for companies like ours, meaning that there's competition for sure. Sometimes one excludes the other, but generally speaking, we'll like Gabon because Gabon is not closed off to any of these potential investors. So I always give an example of, even Millennial Lithium. We don't even have to go back to line up potash, but with Millennial Lithium, our strategic investment, remember, was a Chinese company. It was a solar power company that put in $37 million in when the market was pretty bad, but they believed in the project and the team. But when the time came to sell the company, we had a bidding war, and 2 out of 3 bidders were Chinese companies. But this Chinese investor was pretty agnostic. They were really after financial/commercial returns. So they said, look, we're not just going to vote in favor of the Chinese just because they're Chinese. If the Canadians are giving us a better deal, so be it. So I think it's important to bring in right investors at the right time. Like if I bring a strategic that has an eye on acquiring the company down the road from the East, for example, let's say from China at an early stage, probably I'm going to be stuck with that group. If it's just a financial investor from the East, it's a different matter. So those are the factors that we'll look at. The same thing, if it's a multilateral coming from the West, they're not going to constrain us saying, don't deal with anybody else, because their main mandate, at least, officially, is to make sure this project develops and it contributes to the development of the country, of Gabon, and of course, a wider region. So those are the things we're juggling at. It's not easy, but being in Gabon, it makes it easier because Gabon is not, as I said, closed off to Americans or to Chinese or to Canadians, etc. We can attract investment from almost anywhere. I mean, of course, I'm not talking about Russia and Belarus, and we're not looking there for investment anyway. So.
Yeah. Well, it'd be interesting to sort of see what happens with that market. I think with uranium, it's all been heading east. Okay, that's it. I've forgotten the fact that the lithium, people assume, Chinese want lithium, but in that case, it was a purely financial transaction. That's very similar to what you're trying to do here. Is there a point at which you talk about putting another couple of holes in, maybe looking at expanding the resource number, where it gets too big for a prospective buyer in this space? Because again, it's kind of like it's a kind of small but important space. Can you make these things too big? We've seen that in gold and copper elsewhere in the world. What have you got your mind set on in terms of a target?
Yeah, that's a very good question, man. We always look at it from 2 perspectives. One, our own ability to fund and build this project. So that's why, if you look at it, we're discussing 800,000 ton a year production scenario. But then the other perspective is potential acquisitor who may not actually want to start small. Again, I'm talking about firsthand experience, like be it potash or lithium or uranium in our previous projects. Almost everyone who came in and bought us out, they wanted to double, if not triple, production right off the bat. So, for example, ICL with Atlanta Potash, they wanted to start with 2 million instead of 1 million tons. Kadun Salts out of Germany who bought out Potash 1, where our feasibility study, all the works were based on 1 million ton a year operation. They started from, I think it was 2 million, now 2.2. They want to scale it up to like 3 to 4 million tons. So here we want to show to the market that, the project is economically viable, even with 800,000 ton a year operation. But at the same time, large enough of a resource and potential, even blue sky, leave some of the blue sky there too. In other words, you don't have to explore the whole thing out. That will show the potential buyer that, look, you don't have to be stuck with 800,000 tons. You can actually do a much bigger scale as well.
Right. Okay. Okay. Just again, so back to the macro briefly. What's the potash price been doing over the last 10 years?
So look, pretty much the same. I would say it's been stable in the same bracket probably for the last 10, 15 years, between I would say $250 and $350 per ton. During COVID, it spiked, as many other things, all the way up to $900 per ton. And that's when BHP decided that they want to go ahead with their project in Saskatchewan based on those numbers. Since then, it came down to about 300. So if you look at the market today, Matt, so you got probably about $280 to $290 per ton in Brazil, China, India. In the US, probably around $300 per ton. In Western Europe, is still pretty healthy, about 350 euros per ton. In Africa, it's over $400 per ton because the African market is a little bit patchy. They don't buy in large volumes, so they end up paying a little bit higher price.
Is it consistent purchasing though? I'm trying to work out, is Africa your audience, or do you need to supplement that, or maybe even think about, well, it's all about volume sales, even if it's less. Do I go sell to Brazil or wherever?
Yeah, that's exactly right, man. So we're thinking, look, from what we've found out so far, we can comfortably place 800,000 tons in Africa proper. So if we go above that, so probably, we think if the demand doesn't grow in Africa, respectively, then of course we can look at Brazil. Remember, once in production, we're going to be the nearest producer or nearest supplier to Brazil, right, compared to almost anybody else there. So that is definitely there. Now, also bear in mind, right now we're talking kind of in theoretical terms, because it will also be a the function of who's going to be doing an offtake with us. So, for example, if it's a Western company and says, look, and that's what we had with ICL, for example, so we're buying all your offtake. Here's the cash upfront investment and so forth. But it's up to us where we're going to place it. That could play out here as well. Or it's a specific group, let's say from Brazil or from China, that come in and say, one half of your product, and here's again investment that will support you during production and so forth. Again, that will go probably in that direction, not necessarily all of it will stay in Africa. So at this point, if we're on our own, meaning we have full control, and we decide where the product will go, then most likely all 100% of it will stay in Africa. But if we have a strategic investor / offtaker that wants to take part of that product to their own home country or their own region and so forth, that's also a possibility.
Okay, so one of another phrase, so triple A buyers is what we're looking for, certainty and de-risking on that front. And talking of de-risking, I know Africa is a great place to do business. I've done a lot of business over there, but just on the kind of permitting, licensing component, is this a fairly light touch? How long does that process take?
Yeah, we believe so, Matt. So we have now an exploration license that allows us obviously to do all this works that I mentioned. And once we're done with fees and environmental studies, we get the environmental permit approved and everything, then we will be able to apply for a mining license. And from what we've been hearing from both the president, the Minister of Mines, Minister of Environment, they're really keen on this project going forward. And we're going to be sticking with solution mining, which has the least environmental impact, which is important. I mean, all our previous projects were also solution mining amenable for that reason. So we think that it's going to be a pretty straightforward process. And we have actually watched some of the mining companies go through that process. And so far, knock on wood, they haven't had any issues. There's an iron ore project about 80 kilometers from us, and they got their mining permit early this year, and it went through without any hitch.
Right. Okay. Okay. And I think you kind of lay out the kind of infrastructure available to you. You're down in the sort of southwest of Gabon, port access, etc. So again, well, I'll ask it. So in terms of energy, which is always a big driver of cost and affects margin, etc. But where's that come from? And is it enough for what you want to do?
Yeah, yeah, no, those are important aspects, Matt. So there are two ports that we can access in the next few years. One is being built to brand new ports. It is actually specifically built for resources, including iron ore, potash, and so forth. And the other one is already in existence, but it needs to be expanded. So the government is working on that one. The first one is actually being built by private companies. Now, in terms of energy, yes, we'll need obviously access to the grid and everything else, and the natural gas and so forth, and that will all be available at the port site. So our processing facility, storage facility, and everything will be actually built there. So obviously they will have access to all the infrastructure, and there's plenty of natural gas in the country, so we don't think that will be a problem. And actually, the pipelines are already being built too. That's actually in the plans. And the local energy company already made an announcement, and we did put out a news release on that aspect as well, because it's critical so that all of these components are in place before we even get to construction. So that's one of the things that will keep our costs pretty low. Meaning that the fact that natural gas is there, right now they flared it off, so we can actually tap into that and use it for our own needs, so to speak. Especially with solution mining, where we need to evaporate water using thermal evaporation.
Okay. Well, I think for now, just as an overview and sort of comfort, that's a good conversation. I guess we'll go away and have a look at a bit more of the detail around the drilling and the actual operation, proposed operation, and the technical studies as well. So, Farhad, appreciate your time. Good to see you. Good to see you. And appreciate you coming on. We'll see you soon.
Great to see you too. Yeah, absolutely. Thanks.